The IRS didn't make an error. ProPublica got the files, the actual return data. The wealthiest 25 Americans added $400 billion to their net worth in 5 years. Their total federal tax bill, $3.4 billion, 0.8%. Not a scandal, not a crime, a feature.
Hold on. 0.8. My employer pulls payroll tax before I see a single dollar. Social Security, gone. Medicare, gone. Vanished before it ever touches my account. And you're sitting there telling me someone pocketed $400 billion in new wealth and paid less than 1%.
I'm not editorializing, I'm reading the filing data. And the mechanism, once you see it, is almost elegant in how brutal it is. The tax code makes one distinction. One, most W-2 earners never encounter it because it was never relevant to their financial life. Wages are income, taxed instantly, at the point of receipt. But when an asset appreciates, a stock, a building, a private equity stake, that gain is invisible to the IRS, not until you sell, not until you close the position.
So if your net worth climbs from $1 billion to $10 billion because your stock ran, you owe nothing?
On the appreciation, correct, zero taxable event, and here's where the Fed data becomes critical. As of 2024, top 1% of U.S. households, 38.5% of total national wealth. In 1989, 30.1%. That is not drift. That is not a rounding error. That is a structural migration of national wealth, executed quietly across decades, while the tax code treated every dollar of that appreciation as if it simply didn't exist.
That's not the system glitching. That feels like the system working exactly as someone intended.
Drop the glitch framing. A glitch is an accident. This is architecture. Every mechanism enabling this outcome was legislated, codified, and renewed by both parties across administrations for decades. The question isn't whether the system is broken. The question is, what was it built to do? And when you read the actual statute, not the press releases, not the campaign speeches, the statute, the answer is unambiguous. It was designed to reward one thing. Not income, not labor, ownership.
So wage earners are the fuel source. Asset holders are the engine.
The tax system at its core is a tax on motion. You move money, earn it, receive it, realize it. You trigger a liability. You hold an asset and watch it compound, nothing moves. Nothing is owed. And that single distinction has done more to concentrate wealth in this country than any policy debate in Washington has ever had the nerve to fully acknowledge in public.
Okay, but people aren't stupid. If your wealth is locked inside stock you can't spend, how does a billionaire actually live? How do you fund private jets, properties, a whole lifestyle, without selling anything and triggering that tax?
That is exactly the right question. 3 words answer it. Buy, borrow, die.
That sounds like a threat.
It's the playbook. Legal, documented, used at enormous scale. But here's what matters. Those 3 words only detonate when you understand each step individually. And the final one, the 3rd word, the financial press almost never explains it fully, because when you understand what die actually means inside this structure, what it does to embedded gains, what it does to generational tax liability, the entire architecture of American wealth inequality just locks into place.
Then let's get into it.
We'll get there, but first, the borrow step, because that's where the system becomes genuinely extraordinary. That's where private banks enter, and that's where the separation between the middle class and the tier above it stops being about income and starts being about access. Step 1. Acquisition. You buy appreciating assets. Equities, private equity stakes, commercial real estate. You hold them. You do not sell. The asset climbs. Every dollar of that growth is, under current law, completely invisible to the IRS. No sale, no realization, no taxable event. The gain exists on a balance sheet, in a portfolio statement, but inside the tax code, it doesn't exist. Not yet.
But at some point you need actual cash. You can't live inside a brokerage account. What happens when the bills arrive?
Step 2. This is where the architecture turns genuinely elegant. Instead of selling and triggering a capital gains liability, you borrow against the asset. J.P. Morgan Private Bank, Goldman Sachs. Morgan Stanley Wealth Management. They offer what are called securities-backed lines of credit. You pledge your portfolio as collateral. The bank opens a credit facility. Interest rates between 1.5 and 3%. You draw cash, you spend it, you fund your entire life on borrowed money.
But that's still debt. You still owe it back.
You owe the interest. Here's the critical point. Borrowed money is not income. It does not appear on a tax return as a taxable event. You have just converted $400 million in unrealized appreciation into spendable liquidity without selling a single share, without generating a single dollar of taxable income. The asset keeps compounding. The loan sits at sub 3%. The IRS sees nothing.
How is this even legal? I got taxed on a $200 cash bonus at work. $200. This person borrows against $500 million in stock, and the government collects zero?
Because the tax code taxes income. Debt is not income. That is not a loophole. That is a foundational structural principle baked into the original construction of the code, and it is technically available to anyone with sufficient assets to qualify for these credit facilities. The architecture isn't hidden. It's published in bank product brochures. What's hidden is the scale at which it operates, and the fact that the middle class was never told this was the game being played.
And in the UK, same structure?
Different mechanism, identical outcome. Business asset disposal relief, formerly entrepreneurs relief, caps capital gains tax at 10% against the standard 24% rate. HMRC's own TODS on 25 data shows the annual cost to public revenue, £2.4 billion. 55% of that benefit flows to approximately 5,000 claimants. Average relief per person, £262,000, publicly framed as support for small business owners. The data shows it functions as a capital exit subsidy for high concentration insiders.
So the public narrative and the actual distribution are completely different things.
They always are, and that brings us to the third word, the final step. The one that doesn't just defer the tax, it erases it permanently, because the system only achieves its full architecture, only becomes truly generational if you never close the position. If instead you let time do what no accountant, no attorney, and no shelter can do alone. What happens at that moment is written directly into the Internal Revenue Code, Section 1014. And once you understand what it does, you will never look at inherited wealth the same way again. Section 1014, stepped up cost basis. This is the mechanism that completes the entire architecture. When an individual dies and passes appreciated assets to heirs, those assets are revalued at current market price at the date of death. Not the original purchase price, the current price. Whatever gain accumulated over decades, 10 years, 30 years, an entire lifetime of compounding, is permanently erased for tax purposes. It does not transfer to the heir. It does not get deferred. It vanishes.
Wait, vanishes? The government just forgives it?
The government never sees it. Run the arithmetic. You purchase an asset for $10 million. Over 30 years, it appreciates to $100 million. $90 million in embedded capital gains. Under normal conditions, if you sold, you'd owe federal capital gains tax on that $90 million. But you don't sell. You hold, you borrow against it, you live, you die. Your heir inherits at current market value, $100 million. Their cost basis is now $100 million. They sell the next morning for $100 million. Their taxable gain, zero. The $90 million gain that accumulated across 3 decades, permanently eliminated by statute, legally.
So the tax was never deferred, never postponed. It was just gone.
Gone. And this is not an edge case. The Congressional Budget Office estimated that stepped-up basis shelters approximately $800 billion in unrealized gains from taxation annually. $800 billion every year. Not a one-time figure. A recurring annual erasure embedded inside the estate transfer system, running quietly, in perpetuity.
I don't even have a word for that. I paid capital gains on shares I held for 14 months. 14. And someone holds an asset for 30 years, watches it grow by $90 million, and the government collects nothing?
Nothing. Now layer the real estate dimension. Delaware statutory trusts combined with Section 131 Like-kind exchanges allow real estate investors to roll gains forward indefinitely. Sell one property, reinvest into another, continuously defer the capital gains trigger. Potentially forever. The 2024 DST equity market, $35 billion. Minimum investment thresholds frequently begin at $100,000. Technically accessible to all. Structurally gated by capital.
So it's designed to look open.
While being structurally exclusive.
And the people who qualify are already
Inside, correct.
That $100,000 minimum isn't an accident. You don't accidentally build a capital barrier into a tax deferral vehicle. That's a design choice.
Every element of this is a design choice. And when you assemble the complete structure, acquisition of appreciating assets, securities-backed liquidity extraction at sub 3%, indefinite gain deferral through like-kind exchanges, permanent gain erasure through stepped-up basis, you arrive at one conclusion. The system does not tax wealth. It taxes motion. Selling is penalized, holding is rewarded. And dying, strategically, with the right assets inside the right structures, is the single most tax-efficient financial event a person can execute in their entire life.
So the full playbook is literally acquire assets, extract liquidity tax-free through collateralized borrowing, never sell, and let your heirs inherit a completely zeroed cost basis. An entire lifetime of compounding disappears at death.
The system doesn't tax wealth, it taxes motion, and the wealthiest individuals in this country have simply stopped moving.
Patient capital, that's what we're calling it. Because from where I'm standing, it looks less like patience and more like permanent systemic extraction without contribution.
The data on capital formation pushes back. Long-term equity holdings fund corporate expansion, infrastructure, employment. The case for deferral isn't ideological. It's functional. Patient capital requires protection from continuous taxation. Otherwise, it rotates, fragments, and stops funding long-duration assets.
Then explain the Fed numbers. Top 1%, 38.5% of all household wealth. Bottom 50%, 2.5%. If patient capital funds the economy, why is the economy increasingly owned by fewer and fewer people?
Concentration's a separate variable from taxation structure.
Is it? Because from 1989 to 2024, the exact window these mechanisms were active and expanding, wealth concentration moved in a straight line, upward, uninterrupted. That's not a separate variable. That's a correlated outcome. And correlation inside a design system isn't coincidence. It's evidence.
Correlation's not causation.
No, but policy is intention, and the intention embedded inside Section 1014, inside securities-backed lending, inside business asset disposal relief, that intention has a very specific beneficiary profile. And it is not the median household. It has never been the median household.
Business asset disposal relief was legislated to incentivize entrepreneurial risk. Small business creation. Capital deployment into private enterprise.
And 55% of the benefit flows to 5,000 people. That is the outcome, not the stated intention, the actual documented outcome. HMRC published that data. So at what point does the official narrative become irrelevant and the real distribution become the policy?
Governments don't restructure politically stable systems. The beneficiaries of this architecture are systematically influential. They fund political infrastructure across party lines, reform proposals surface, they die in committee. That is not conspiracy. That is how capital defends itself inside democratic systems.
So you're admitting it's untouchable?
I'm saying it is durable. There's a distinction.
And meanwhile, wage earners finance the state. Payroll taxes extracted before the money arrives. Income taxes on salaries, on overtime, on bonuses. The individuals with the least mobility inside the system carry the highest effective burden relative to their wealth accumulation, while asset holders, at scale, operate inside a structurally different tax environment, a parallel economy, running alongside the one everyone else is trapped in.
That asymmetry is real. I won't deny it.
Capital is mobile. Wealthy individuals relocate. Trusts move jurisdictions. If the US or UK ever seriously attempted to close stepped-up basis, eliminate securities-backed lending advantages, restructure capital gains treatment, what actually happens?
Capital flight is not theoretical. It is documented. High net worth migration accelerated after every serious reform proposal in both markets, Ireland, Portugal, UAE, Singapore. The architecture of global tax competition means any unilateral reform immediately creates an arbitrage window in another jurisdiction. Reform becomes self-defeating at scale.
So the system protects itself by ensuring reform costs more than it recovers.
Precisely. And that is why the most dangerous thing happening right now isn't the wealth gap itself. It's one quiet proposal gaining traction in Washington. One bill, targeting one specific rule, one line in the code, and if it passes, every calculation in this entire structure changes overnight. If the system rewards ownership over income, the protocol becomes simple. Stop optimizing for income. Start acquiring assets, index funds, broad equity exposure, real estate investment trust. These are not sophisticated instruments. They are entry points into the appreciation economy. Every dollar sitting in a savings account at 2% is a dollar that is opted out of the compounding system running on the other side. The first move is structural reorientation from wage dependency toward capital participation. It does not require millions. It requires a decision.
So step one is just own things. Stop renting your financial life and start holding a piece of something that appreciates.
Exactly. Step two, leverage literacy, not consumption debt, not credit cards, not financing a depreciating asset. Understanding how asset-backed the borrowing actually operates, how equity in a property or portfolio can be accessed without triggering a sale, without generating taxable income. That is the knowledge gap between the middle class and the tier directly above it. You don't need a private account at Goldman Sachs to understand the principle. You need to understand that debt against an appreciating asset is a tool. Used correctly, it is how liquidity gets generated without a tax event. Used incorrectly, it is how the middle class finances consumption and structurally falls behind.
And step three,
tax code literacy. Know your realization triggers. Understand holding periods. Understand how long-term capital gains rates separate from short-term. Understand what stepped-up basis means for your estate, and even at modest asset levels. Know that these rules exist, that they apply at every wealth level, and that ignorance of them is not a neutral position. Ignorance is a tax you pay voluntarily every year without a bill arriving.
So the full protocol: acquire appreciating assets, understand how to extract liquidity without triggering a taxable event, and learn the architecture of the system you are already living inside. Because the system does not care whether you understand it. It runs regardless.
It runs regardless, and right now, it is running in one direction.
The proposal you mentioned, the one gaining momentum in Washington, the one that changes everything. What is it exactly?
There is a bill. It targets stepped-up basis directly. If it passes, the entire generational wealth transfer mechanism, the third word, the permanent erasure, gets restructured. Trillions in embedded gains become exposed to taxation for the first time, and the families currently protected by that single line in the tax code, they are already moving assets in response, before the vote, before the bill even reaches the floor.
They're repositioning, right now, while everyone else is still figuring out the rules of the last game.
The next file covers exactly that: who's moving, what they are moving into, and what that capital migration tells us about where the system fractures next. That file is the one they would prefer you never open.